Hello there, this is Bizworld. The World Bank has revised upwards its GDP growth forecast for Malaysia to 6.4% in 2022, against 5.5% projected earlier. According to World Bank lead economist for Malaysia, Apurva Sanghi, the positive revision was driven by heightened economic activity recorded in the first half of the year.
Services and goods that are that have a cost in ringgit and get in revenues in dollars, given the Malaysian ringgit US dollar exchange rate, should receive a boost. So what are these services? Well, if you think of tourism is one such sector that can benefit from what's going on, as well as commodity exports, so they should receive a boost.
However, the bank also revised downward the country's GDP growth estimate for 2023 to 4.2% from 4.5% earlier. Malaysia's export demand may be adversely affected due to the Ukraine war and the slowdown in China, which is the country's largest direct trading partner. Meanwhile, Apurva opines the move by Bank Negara to hike the overnight policy rate to 2.5% is an act of normalising, as it is still below pre-COVID rate. He added that Malaysia needs to maintain a certain spread between the US Fed funds rate and the OPR in order to avoid triggering capital outflows if the spread is too wide. More than half of Islamic finance professionals expect a dramatic increase in digitalization over the next 3 years. A study by IslamicMarkets.com also revealed a prediction in increased spending and investment by Islamic finance institutions on technology, as well as building new digital financial services over the next 5 years. According to IslamicMarkets.com, digitalization was on the march in the Islamic finance sector. Greater digitalization is central to the adoption of open banking, open finance and embedded finance in Islamic finance. Kenanga Research remains cautious on seaport operators in general, buffeted by a weak outlook for global trade. The World Trade Organization recently downgraded its global trade growth forecast for 2022 to 3% from 4.7%, while remaining cautious for 2023 at 3.4%. The firm noted a recession in Europe was almost a foregone conclusion given the protracted Russia-Ukraine war, resulting in an energy crisis. Globally, consumers' confidence and spending are likely to take a beating on sustained elevated inflation, rising interest rates, and as households deplete their pandemic relief funds. However, the firm sees a bright spot in the logistics sector locally, given that it was primarily driven by domestic demand. Bus and bus body manufacturer Gemilang International Limited (GML) has purchased 200 units of electric buses from a joint venture JV company to be formed between Computer Forms Malaysia Berhad (CFM) and Energy Absolute Public Company (EA). The proposed JV company would distribute EA's products, including electric buses, in Malaysia. The purchase was driven by the letter of mandate (LOM) that GML received from Go Electric Automotive Sdn Berhad (GEA). GEA would be the ultimate owner of the 200 electric buses once the homologation of the buses for the Malaysian market by GML was completed. It is a Malaysian company involved in the business of leasing zero-emission vehicles to end users with a target for 200 electric buses to reach local roads by 2023. PT Resources Hildingsborough made its debut on the ACE market at 37 cent against its initial public offering IPO price of 36 cent. At the opening bell, the counter saw 16 million shares changing hands.
We already are in the export market, but we intend to actually expand further, especially in the Middle East and Asia Pacific, such as like China, Saudi Arabia. We are going to further expand it.
The frozen seafood processor company is optimistic that the success of its IPO would provide it with the necessary resources to pursue strategic goals. The company has raised 48.6 million ringgit from its listing, in which 17.6 million ringgit would be allocated to finance the capital expenditure for a new cold storage warehouse. That's all the time we have for Bizworld. I'm Nadia Azmi. Thank you for investing your time with us.